Hey everyone, the purpose of today's video is to give an explanation of what net working capital is and how it's used to analyze a company. First, I'm going to give a brief overview of what net working capital is. Then I'm going to show you the balance sheet accounts that are included in net working capital. And I'll wrap up with talking about the change in net working capital and why that's important to look at when analyzing a company. So jumping into it, net working capital is a measure of a company's liquidity and is calculated by taking the company's current assets and subtracting its current liabilities. Now, all a company's current assets are any assets that are expected to be converted to cash within a year, and the company's current liabilities are any liabilities that are due to be paid to another party within a year. Now, the reason this is a measure of liquidity is because it tracks if the company has enough current assets to pay down its current liabilities. Now let's take a look at the balance sheet accounts that are included in net working capital. As I said on the previous page, net working capital is calculated by taking the company's current assets and subtracting the company's current liabilities. Now, the main accounts you'll find in current assets include cash, accounts receivable, and inventory. And the main accounts you'll find in current liabilities include accounts payable and accrued expenses. Now, when taking a look at the example balance sheet on the left, you'll notice that in 2019, the company had a positive net working capital balance of $25,000, meaning that it had sufficient liquidity for its current assets to cover its current liabilities. And then in 2020, the company also had a positive net working capital balance of $20,000, once again, meaning that the company had enough current assets to cover its current liabilities, providing the company with sufficient liquidity for the year. Now that we have an overview of the main accounts that are included in net working capital, let's take a look at the importance of analyzing change in net working capital from one year to the next. While it's important to analyze the net working capital balances each year, it's also helpful to understand how a change in net working capital from one year to the next impacts cash. Now, if you had a chance to watch my previous video giving an overview of the three financial statements, you'll remember that a change in a current asset or current liability account will also have an impact on cash. For current assets, an increase year over year represents a cash outflow, while a decrease year over year causes a cash inflow. Now, I know this is a confusing topic to understand, but what helped me understand this concept was looking at inventory. So if our inventory balance increased from one year to the next, that meant we had to go out and purchase more inventory, representing a cash outflow. While if our inventory balance decreased year over year, that meant we were able to sell more inventory, representing a cash inflow. Now, on the flip side, looking at current liabilities, an increase in a current liability account year over year represents a cash inflow, while a decrease in a current liability account year over year represents a cash outflow. Now, an example of one of these accounts would be accounts payable. And an increase in accounts payable meant we were able to withhold some payments from vendors or suppliers, meaning that we could hold more cash on our balance sheet, while a decrease in accounts payable meant we had to go out and pay more of our vendors and suppliers, representing a cash inflow. In looking at these two concepts together, net working capital is our current assets minus our current liabilities, So an increase in our net working capital account represents a cash outflow, and a decrease in our net working capital account represents a cash inflow. So once again, it's very helpful to analyze our net working capital balances each year, but we should also understand how a change in our net working capital accounts from one year to the next impacts cash. To sum everything up, hopefully after watching this video, you have a better understanding of what net working capital is. You understand some of the main balance sheet accounts that are included in net working capital, and you also understand the importance of analyzing change in net working capital from one year to the next and the impact that that has on cash. Now, if you found this video helpful and there's another topic in finance that you would like me to explain, please leave that in the comments below, and I look forward to talking to you guys again soon.